Hi, today our team are going to discuss about our study case of Apex Aldi Berhad. My name is Muhammad RIFDI. My metric number is 313153. And I about to discuss for accounting treatment for plantation division. First, we have our bearer plants. Mature oil palm trees are classified as bearer plants and are governed by MFRS 116. This is because a bearer plant is a living plant used to produce agricultural goods over more than one period, functioning much like fractionary machinery. They are measured using either the cost or revaluation model to faithfully represent the physical depreciation and economic wear and tear over time. Second, we have biological asset. The fresh fruit bunch actively grown on those oil palm trees fall under MFRS 141, while unharvested fish agriculture produce stay within a MFRS 141 and be measured at fair value less cost to sell at the end of each reporting period. This spread treatment ensure financial statement transparently reflect both long-term capital depreciation and real-time market price fluctuation of the crops.
Hello, my name is Muhammad Arif Faisal bin Effandi with the metric number 313678. Now we move on to question B, which is to evaluate the CFO's valuation approach. The CFO's approach fails to achieve a faithful representation of the company's financial position and performance for the projected yield of a mature FFB. This is because it compromises several qualitative characteristics under the IASB conceptual framework, which is a financial depiction must be complete, neutral, and free from error to achieve faithful representation. The CFO's method fails to achieve these characteristics because it ignores the risk and costs associated with immature FFB, and also CFO treats an incomplete risky future asset as a certain and completed current asset. Next, the conceptual framework requires transactions and events to be accounted for in accordance with their economic substance rather than merely their legal or physical form. So, the CFO's decision to apply the prevailing market price of 650 ringgit per ton for the harvested FFB to value immature FFB still on the palm without any risk adjustment is totally wrong because the economic substance of immature FFB at an early stage of development is fundamentally different from harvested FFB. Therefore, by recognizing the full revenue or gain today, the company is misrepresenting an ongoing manufacturing or growing process as a completed sale, which will increase the profits for the company. A more faithful valuation approach will be using the income approach, which is the discounted cash flow model. By calculating the fair value of a mature FFB using estimated market value of mature yield minus expected cost to mature, harvest and transport minus risk and time value adjustment. That's all from me.
First, I will discuss the ethical risks based on the International Ethics Standards Board Accounting Code of Ethics. The first ethical risk is integrity. As accountants, we must be honest. In this case, using the full market price for immature FFB may overstate the asset value and mislead investors. Therefore, following the CFO instruction would compromise my integrity. The second ethical risk is objectivity. I should make professional judgments independently and not be influenced by management pressure. Even though the CFO wants to attract a strategic investor, I must remain objective and comply with professional standards. The third ethical risk is professional competence and due care. I have a responsibility to ensure that the valuation complies with MFRS 141. Since the FFB are still immature, using the full market price without adjustment may not reflect their actual value. Next, I will explain the steps before and after raising my concerns. Before raising the issue, I should first review MFRS 141 and the IASB Code of Ethics to make sure my concerns are supported by the relevant standards. Then, I should discuss the matter professionally with the CFO itself and explain why the proposed valuation may not comply with MFRS 141. If the issue is still not resolved, I should document the discussion, avoid being involved in misleading financial reporting, and report the matter through the appropriate channels if necessary. Finally, I will discuss my professional obligations to external users. As a professional accountant, my responsibility is not only to my employer, but also to investors, creditors, regulators, and other stakeholders who rely on the financial statements entirely. Therefore, I must act in the public interest by ensuring that the financial statements are reliable, comply with MFRS and ethical standards, and do not mislead external users. Thank you.
So, to answer the question 1, for property 1, it is a mixed-use property. The 7 floors rented are classified as investment property under MFRS 140. The remaining 3 floors are used as the company headquarters, so they are classified as a property, plant and equipment under MFRS 116. So for property 2, the land is classified as an investment property under MFRS 140. And lastly, property 3 is classified as an inventories under MFRS 102. For question B, property 1 is a mixed-use property. The 7 floors rented to a tenants are classified as an investment property under MFRS 140 and may subsequently be measured using the fair value model. The 3 floors used as a company headquarters are classified as a property, plant and equipment under MFRS 116 and are subsequently measured using either the cost or revolution model with depreciation recognized. Second, property 2, being land for an undetermined future use, is classified as investment property and may subsequently be measured using either the cost model or fair value model. And finally, property 3 is classified as inventory under MFRS 102 because it is being constructed for sale and is measured at the lower cost and net realizable value. Therefore, the CFO's proposal to classify all these properties as investment property and apply the fair value model is incorrect, as it does not reflect the true economic purpose of each asset and may mislead the investor.
Good day, everyone. Introducing myself, I am Muhammad ZIKRI bin ASRI, matrix number 313A7. So my part covers the food manufacturing division under MFRS 137, provisions, contingent liabilities, and contingent assets. First, for the product recall, the company should recognize a provision of 1 million ringgit. This is because the recall announcement creates a present obligation. It is probable that the company will incur costs, and management can make a reliable estimate based on previous recall experience. Therefore, all 3 recognition criteria under MFRS 127 are satisfied. Next, regarding the consumer lawsuit, the company should not recognize a provision because the legal advisor estimates only a 30% chance of losing the case. Since an outflow of economic resources is not probable, the lawsuit should instead be disclosed as a contingent liability in the notes to the financial statements. In conclusion, this case shows that uncertainty plays an important role under MFRS 137. A provision is recognized only when an obligation is present, an outflow is probable, and the amount can be estimated reliably. Otherwise, the item is disclosed as a contingent liability rather than recognized in the financial statements. Thank you.